Welcome to the Platinum Channel and the Week in Review. I was really having a hard time putting this video together because I use the Platinum Channel Friday call every Friday, and I take segments out of it and I review those on the call or on this video. And there's so much content in Friday's call that I came to this conclusion. What one thing out of this Friday's call would actually add benefit to a majority of the people who are going to watch this video? And that is the addressing of how do you manage your core and long-term portfolio. And so that is what this video is about today, and some techniques on how to do it. So let's get going. In this first segment, we get into using stop losses on long-term positions, but also using the 200-day simple moving average as a baseline of when to be in a position and to be out of a position in your core portfolio. We get into a lot of different things in this segment. It's a little bit longer than usual, so stick with it. There's a lot of good information to guide you when it comes to managing that core portfolio.
Yeah, I just got one question. I know what you're talking about, your swing trading, your short-term holdings, but Mark, in the case of your long-term holdings, are you using stop losses on them?
Yeah, because I look at longer term charts instead of daily charts. You might look at weekly or monthly charts, or you can use, this is the old one, the old standard is the 200-day moving average. So here you go. If you're in this, you had your stock one full candle above the 200 and you ride it back up. And for what you're trying to do, Bob, is miss
that true. 200 days fallen.
Yeah, look at this.
Yeah.
Let's say you got in, I'm just going to draw a line. Let's say you got in, I'm just going to pick here.
Okay.
Let's say you're in this ETF and you get in somewhere in here, Bob. It's going sideways. You get in and you're an investor. About this point here, which is the end of the year in 2022. So you are now losing money. You're in here. Here's price action. This is called opportunity cost with your money. You're not making any money or actually losing money. You might be getting some distributions. Yeah, let me see. I gotta move my. So you're still out of money. This is opportunity cost lost. Okay.
Yes.
If you would use, well, see here, not even over the 200 yet. If you would have waited and got in here, okay. I can't even get the 200. Go back that far. It's been so far.
Apple might be better.
Yeah. Which one? Apple. Yeah, let's do Apple.
Yeah, it might be better because the 200's going up. It's easier to.
There you go.
Logically, yeah.
Yeah. Yeah, there you go, Paul. Oh, here's my 200. So if you would have gotten in up here, let's just say this line right here. Well, let's go right down to the 200. Here's our 200. Let's say we got out here, the 200. We missed all this downside. We're watching the 200, watching the 200. You could take that money, put it in a treasury bill, and then you see it pop above the 200. You get back in, comes back down. You either stay in or get out. You probably, I don't know if that's a full candle. Get out, get back in. You ride it back up. You missed that missed opportunity cost. You're still riding it. You came down. You might have gotten out here, okay? But then you're right back in. So what you've done is you've missed all of this losses. And this is just on a 200. This is an easy way to do it on your investments. We have more technical ones that do a little more than this. But the 200 is something that Paul Tudor Jones used in 2008 to get out of the market before the big dump. So again, if you have an investment, long-term investment, Bob, and you're worried about losing it, you can kind of do this on a long term. If this comes back down and gets under the 200, you might want to consider, it's not financial advice, but you may want to consider just based on, the long-term trend to pull it out, put it in treasuries, and then when it comes back up, put it back in. Save yourself.
It's not a complicated strategy.
No, it's not. It's a really elementary.
Go ahead.
I think, when Paul Tudor Jones, one of the most successful investors of all time, manages billions of dollars for people and now for himself. And he flat out says, I got out of the market because it broke the 200-day moving average. You got to sit back and go, well, maybe he's got something there, you know? And for the average, having come from 20 years in the financial advising business and understanding how those guys get paid or their broker dealers get paid, being out of the market doesn't pay that broker dealer. And that's why they're so adamant about just hold the 60-40 split. Just hold it out. It'll come back. Whereas if they were taught, if it breaks the 200, if the S&P breaks the 200 or whatever position breaks the 200-day moving average, you start to reduce your position. So many people in retirement would not have gone through .com, housing, the COVID and whatever else is to come. They just wouldn't. But
Yeah.
it's all about getting paid.
You know,
So-
Wonder if we
Trent,
could have
I'll
a
tell you something. It's so important. I look at myself. I mean, you can have all the degrees you want in finance and that. And
Yeah.
these things that appear to be quite elementary, I wished I'd known this about 30, 40 years ago. It would have changed my life totally.
Yeah,
Oh,
it would change everyone's because, it's even today, people that I know, they spend more time planning their vacations than they do their financial future, And I'll ask them, what are you in? I don't know. It's like, I got my guy. I says, well, doesn't he tell you what you're in? Well, I get a statement. Well, how often do you talk to him? Well, once a year when I pay him or, whatever. And they don't understand. And then this year we've had several times where I've talked to people and they're just mad at their financial advisor because they're looking at, an S&P or, up 15-20% or the NASDAQ up whatever. And they're looking at their statements and they're looking at 3% maybe or 4%, and they're just furious. Well, how often does your financial advisor go in and look and actually adjust your account based on anything? They don't, because they get you into a balanced portfolio. They say, all a balanced portfolio does, and even Warren Buffett says it, is give you a balanced, lower return rate because you got all the losers with the winners in there, pulling them down. You got bonds and you've got money and you've got international stocks and you've got little stocks and you got medium stocks and you got growth stocks and you got value stocks all in there. And value can be the way to go, or growth can be the way to go, but everything else pulls you down. So what you end up with is a portfolio of mediocrity.
Yeah. And by the way, it's interesting you say this, Mark, because Kerry just brought that up on YouTube today. He had Warren. I know, well, he didn't have Warren live, but Warren is very much an opponent of diversification. You're not doing research on if you do research on the companies that you're want to be involved in, you should know what's going on. You don't really need that diversification.
One of the bigger things I've learned over the last 25 or so years of being in this investment game and owning a financial advisory practice is the majority of people get attached to a company. They get attached to an idea. What they don't get attached to is what is the limit that they're willing to lose and willing to gain, and how much risk are they willing to take? And that's what I really stress in this next segment is get rid of the idea of a company in particular, that it's the company, but rather get in love and fall in love with the idea that I'm not going to lose enormous amounts of money because somebody at a company has a great idea.
I think
Under the 200-day window.
one of the things I've learned is that we get attached to names and ideas.
Yep.
I think the best idea to get attached to is I promised myself not to lose X% in anything. So if I own NVIDIA and I say this is my long-term core holding, I promise myself I won't lose 7 to 10% of this position. And if I get close, I match it up with a simple 200-day moving average or a 90-week moving average or something like that. And if that rules are broken, then I sell it. And I think that's more of what we as core position holders need to adapt is if I lose 10%, more than 7 to 10%, I got to make all that up. And in a downward trending economic environment, it's going to be a long time. Unfortunately, we age. And, I remember after the housing crash, the average 401k holder that we used to manage 401k plans took 4 years to get back to where they were prior to the crash. But when you're 55 years old, in 4 years later, you're finally at break even. You don't get that time back. And so I think that's the misunderstanding and the robbery of what people has been taught.
Well, it's the robbery of the middle class and the retail investor. It's a robbery of their wealth. It really is. And it's putting trust in an industry that has continually, and I've worked in this industry, screwed the retail investor each and every time. Okay. And it's not illegal in any way. Might be a little immoral, but it's making money. And they're throwing a little bit of crumbs out there. I mean, you're making some years 7-8%, I'm sure, on returns, and other years you're losing 10%, and in the end you're making 3 or 4% over your lifetime of dollar cost averaging in your 401k. At the end, you're going to have a nice little amount there that you wouldn't have had if somebody didn't make you put that in there. It's just what they put it in there and how they manage it that could have made you more. You know.
I often think about, I remember meeting I don't know if he's still the fund manager for the Fidelity Contra Fund. This guy, he got into Google when Google IPO'd, and it was a big chunk the last time I looked at it. And I always thought, if you just followed the 200-day or some version of that in a weekly period of time, and just held that fund, and then when it broke that simple moving average, and then sold it, and then got back in when it broke back up north, you'd have made a crap ton of money.
And then over the course of a year, you would probably only traded 2 or 3 times, maybe.
Oh, in a bull market, think about it. From 13 to 19, you would have never sold it.
No,
never.
No. But you would have been out between 08 and 09 for sure.
Absolutely.
Yeah.
And I think that's, when it comes to core holdings and going to Bob, as you mentioned, Kerry's video about diversification, you don't have, not advice or a recommendation, you don't have to be diversified a 60-40 split. You just have to have the process. And I think that's what swing trading has taught me and a lot of people is I can apply these short-term concepts to a long-term perspective, and I can start to see how to manage my core.
And finally, in this segment, Mark goes through how to use the 200-day moving average. Now, this can be applied to the 200 or the 90 or a combination of the 200 and the 50. But what he sort of lays out in a bigger period of a chart, in this case, 5-year chart, it shows you if you had just had this one approach to managing your core portfolio, you could miss out on a lot of lost opportunity when it comes to losing your money going downward and preserving a lot of those big capital wins.
Here's 5 years of Tesla. Okay. So if you would have gotten in, let's say back here, you got above the 200. Okay. And it's very small. But you rode Tesla from, I'm just going to pick it out, 23, 26 right here. Okay. You're above the 200. You're still above the 200. You're still above the 200. And I'm saying that Tesla is my investment. You come all the way up here, you're still above the 200. Come back down, right in here somewhere, you might have gotten out. Okay. So now you're at 200 or 190.95. So from $23 to 190, you are out. But you made that profit. And then it kind of goes sideways here. Very small, sorry. And then it pops above the 200 again. Now, let's just say it's right here. 218. You ride this, still above, and then it comes down and it might have dropped here. Okay. You're at 268. Okay, so you made from 218 to 268, about $50 a share. Came back up, you go up, you go above again right here. I'm just looking 290. Rides all the way up, comes back down, 292. You made $2 on that. You got out, you missed all this opportunity here. Probably didn't do much here. You missed all of this and got back in right over here. And I'm just going to say it's 193.17. And right now we're at
That's 1 year later.
252.51. Okay, so you're missing everything that's under here is called a lost opportunity cost. Everything over here, you're called your profits. That's just using the 200.
And
That's
so
on what
would that be a daily
on-
chart that you're looking at though? I mean,
this is a daily chart. Yep.
okay.
You could do, I mean, if you wanted to do a weekly, you could do a weekly, I'm sure, if I can find mine. So here's your 1 year. So here's where you probably would have gotten in if you're just doing long term. If you're just using the 200, okay, simple. You're in at 203.93. You might have gotten out right in this area, 216. So you're up, $14. You come back down, and here's your sideways. Then you pop back in, 237, and you're still in today at 252. So you're up, whatever, 52 minus 37. And that's just that's an investor style. But the way you get in trouble is when it goes sideways a little around the 200, because the 200 acts as support or resistance. And sometimes, like here, you got several days, you're just kind of going back and forth. That's when you might want to just sit out and just wait and see which way it pops up or down. And here we went again. We went sideways here again. But for a majority of the time, you're seeing either ups or downs. Again, here's sideways too, but you're over the 200. So if you'd have got in here, you'd be sideways, you'd still be doing okay.
I hope you have found this video very educational and very helpful when it comes to your core portfolio. Remember, it is not your perception of what the market is going to do. It is the guy who sits across the table from you and his perspective of the market. By simply having a simple process to manage your core portfolio, you can avoid major drawdowns, major economic blowups like we've seen in the last, 23, 24 years with the dot-com bubble, with the housing bubble, with the COVID bubble, and now we're entering the leveraged up to the hilt bubble. And you could avoid all those down losses and preserve capital and achieve those dreams that you have always wanted much, much sooner by simply having a long-term strategy that preserves capital. I hope you've enjoyed this video. Subscribe to our YouTube channel, along with check us out at Best of US Investors, and subscribe to the Platinum channel, where you will get enormous value, enormous value from the strategies and the topics we talk about, along with different portfolio ideas to construct and learn how to properly invest. Check us out at bestofusinvestors.com. Peace, live loud, and Merry Christmas.